Somewhere in America right now, a family just lost their house. Not because of a market crash, not because of a layoff, because the person who paid the bills died and there was no life insurance. Welcome to Warren's portfolio. Here's the number that should terrify you. 102 million American adults say they need life insurance or need more of it, but haven't bought it yet. That's not a coverage gap. That's a financial time bomb sitting in millions of households. My name is Warren. 6 months ago, I didn't have life insurance either.
Not because I didn't care about my family, because I genuinely had no idea what I was buying or who was lying to me about it. And here's the part that's going to make you uncomfortable. One entire category of life insurance, the kind sold to you the hardest with the biggest commissions attached, is for most people a financial trap dressed up as protection. I'm going to show you exactly which one and exactly what to buy instead. But first, you need to understand why this industry is built to confuse you on purpose.
Let's start with the only question that actually matters. Why does life insurance exist at all? It's not an investment. It's not a retirement plan. It is income replacement. If you died tomorrow, would the people who depend on your paycheck be financially fine or financially destroyed? If the honest answer is destroyed, you need coverage. Full stop. Now, here's where the industry splits into two completely different products.
Term life insurance and permanent life insurance, sometimes sold as whole life, universal life, or variable life. They sound similar. They are not similar. One of them is overwhelmingly the right choice for most people. The other is overwhelmingly profitable for the person selling it to you. Let's start with term life insurance. You pick a term, 10, 20, or 30 years. You pick a coverage amount, say $500,000. You pay a fixed premium for that term. If you die during the term, your family gets the payout. If you don't, the policy simply ends. No payout, no refund. That sounds like a downside. It is not, because term life insurance is staggeringly cheap. A healthy 35-year-old can often get a 20-year, $500,000 term policy for around $25 to $35 a month.
That's the price of a few coffees a week to protect your family from total financial collapse. Now, here's permanent life insurance. And here's where the open loop starts to resolve. Whole life insurance combines a death benefit with a savings component called cash value. The sales pitch sounds incredible. It's insurance and an investment. You can never outlive it. You build wealth inside it. Here's what they don't lead with. The same $500,000 of coverage that costs $30 a month as term can cost $400 to $500 a month as whole life. That's not a typo. That's 15 times more expensive for the identical death benefit. Where does that extra money go? Into fees, commissions, and a cash value account that often grows so slowly in the early years that you'd need a decade or more just to break even on your own money. Financial advisors who don't earn commissions selling insurance, fee-only fiduciaries, overwhelmingly recommend term life insurance for the vast majority of households. The math isn't subtle here. If you took that extra $400 a month and simply invested it in a low-cost index fund instead of a whole life policy, history suggests you would likely end up with dramatically more money than the cash value the insurance company credits you. So why does whole life insurance still get sold so aggressively? Because the commission on a whole life policy can be 50 to 100% of your first year's premium, sometimes more. On term insurance, that commission is a fraction of that. The incentive isn't to protect your family efficiently. The incentive is to maximize what gets extracted from your wallet. That's not a conspiracy theory. That's just how commission structures work, and it's publicly documented in insurance industry compensation data.
So here's the exact framework, no fluff. Step 1, calculate your real coverage number. A common starting formula is 10 times your annual income, adjusted for debts, your mortgage balance, and future expenses like college costs. Step 2, buy term life insurance. Not whole life, unless you have a specific advanced estate planning reason that a fee-only financial advisor has confirmed in writing. Step 3, match your term length to your obligation. If your mortgage has 25 years left and your kids won't be financially independent for 20 years, a 25 to 30-year term covers both. Step 4, shop multiple insurers. Premiums for identical coverage can vary by hundreds of dollars a year between companies for the same health profile. Step 5, if someone tries to sell you whole life insurance before they've asked about your debts, your dependents, and your existing coverage, that's not advice. That's a sales script.
Here's the truth this entire industry doesn't want printed in bold. The best life insurance policy is boring, cheap, and term. If it sounds exciting, has an investment pitch attached, and a commission-based salesperson is sweating to close it today, that excitement is costing you thousands. Warren didn't need a complicated policy. He needed a simple number, multiplied by years, protecting people who actually depend on him. And if you want to see exactly how disability insurance fits into this picture, the coverage that's statistically more likely to actually pay out than life insurance, that breakdown is coming in the next video.
Subscribe now, because most people don't even know that gap exists until it's too late. This is not personal finance. This is financial warfare. And the policy that protects your family without draining you while you're alive, that's the only kind worth signing.